Welcome to Talk Tickers, where we break down the earnings calls that move the market. Today, we're digging into Terex Corporation's Q2 2025 results. And let me tell you, the headline number does not tell the whole story. Let's get right into it.
So on the surface, everything looked pretty good, right? Terex came out with an adjusted EPS of $1.49. That's a solid 6% beat over what the analysts were expecting.
But here's where it gets interesting. That headline beat? It's kind of hiding the real story. As management themselves put it, this is a company running at two totally different speeds. You've got one part of the business that's just crushing it, basically carrying the weight for its older legacy parts.
All right, so let's dive into those headline numbers first, and maybe more importantly, why the market reaction was, well, a little lukewarm.
Okay, so on paper, this was a really clean quarter. I mean, they beat expectations on revenue, they beat on earnings, and look at that free cash flow conversion, 108%. That's impressive. It tells you they're running a tight ship, operationally speaking. But the market just wasn't buying it hook, line, and sinker. Yeah, the stock popped a couple of percent on the day, on heavy volume, mind you, but then it just kind of fizzled out in the next session. And that's a huge tell. It means investors were looking right past those shiny headline numbers and were digging into what's happening underneath. And that brings us right to the heart of the matter this quarter. It's really a tale of two different companies under one roof. You've got the growth engine, and then you've got the legacy anchor. So if you look at where the money's coming from, the old school aerial segment is still the biggest piece of the pie. But the real story, the one you need to pay attention to, is Environmental Solutions, or ES. Thanks to a really smart acquisition, it's now almost a third of the entire business. And believe me, it has become the company's absolute critical growth driver.
And when I say growth driver, I mean it. Let's dive a little deeper into this ES segment because it is just firing on all cylinders. This is where all the good news is for Terex right now.
Just look at these numbers. You've got sales up almost 13% pro forma, an operating margin of 19.1%. Wow, that is just incredible. They're saying the synergies from their recent acquisition are running well ahead of their own targets. Management is so confident, they actually raised the full-year outlook for this segment. That's a huge vote of confidence.
Okay, so that's the good news. Now, let's flip the coin and talk about the other side of the business. The legacy aerial segment is really facing some major headwinds, and it's dragging down the whole company's performance.
So what's the problem here? Well, the big issue is margin pressure, and it's coming from a shift in their customer mix. See, the smaller independent rental companies, they're getting nervous about high interest rates, so they're pulling back on buying new equipment. This means Terex has to sell more to the big national accounts, which, you guessed it, have lower margins. The result? They had to slash their full-year outlook for this whole segment to down low double digits. So, with one part of the business booming and the other struggling, what's the game plan? Well, management is actually being pretty smart about this. They're focused on two things: reshaping the entire portfolio and using their unique manufacturing footprint to their advantage.
First up, they're being upfront about the growing tariff problem. They've quantified it, and now they're expecting a 50-cent per share hit for the full year. That's up from 40 cents before, mostly because of escalating trade tensions.
But here is their secret weapon, their strategic counterpunch. The CEO, Simon Mester, made a fantastic point on the call. He highlighted their Made in America footprint. Think about it. With 75% of their U.S. sales produced right here in the U.S., they have a natural shield against a big chunk of these import taxes. That is a huge competitive advantage.
And this isn't just a short-term fix. It's all part of a very clear long-term strategy to make the company less risky, less cyclical. They're deliberately moving away from the volatile aerials business, doubling down on the high-growth ES segment, selling off stuff that doesn't fit, like their cranes business, and all the while making sure they're generating cash and giving it back to shareholders.
Okay, so we've looked at the good, the bad, and the strategy. Now let's put it all together. What's our forward-looking call on Terex? What happens next?
All right, time to put on our analyst hats. How should we think about this stock going forward? What's the trade here?
Our call is a market perform, and here's why. That incredible, and I really mean incredible, strength you're seeing in Environmental Solutions is doing a fantastic job of offsetting the drag from the legacy businesses and all the macro noise out there. It's basically a perfect balance.
So the thesis is really a push and pull. The bull case is simple. ES is a beast. It's a growth engine that puts a really strong floor under the company's earnings. But the bear case is just as strong. The headwinds in the much larger aerial segment are real, and they're going to cap any big upside in the near term. So until that legacy business stabilizes, you can't really be more aggressive than neutral.
So what do we predict? We think the stock is going to be stuck in a range for a bit, probably bouncing between $48 and $52, while the market just tries to figure out this two-speed story. Now, the real catalyst, the one thing that could break this stock out of its rut, is any sign that those smaller rental customers are starting to spend again. That is the signal the market is waiting for.
And as always, please remember, this is not financial advice.